All right, folks, look, Jay Powell and the Fed went ahead and raised their target rate by a quarter point, as everybody expected. They also changed their written statement a bit in a way that seems to open the door for rate hiking pause. Okay, long-term yields fell a bit. Counterintuitively, the stock market dropped, I think, 270 points. All right, so it goes. What Jay Powell should have said is how important it is for the Congress to pass a debt ceiling increase that includes budget reforms. I'm not even asking him to endorse Kevin McCarthy's excellent plan directly. But if Powell had a backbone, he would have made it clear that at least generically, the Republican House plan would make the Fed's job easier and might even guarantee that the Fed rate hiking would stop. After all, they want to cut $130 billion off of the FY23 spending, up to $500 billion in FY24, put a 1% cap on future spending. That would all reduce inflationary pressures from the fiscal side and would make the Fed's job easier. Remember, the McCarthy plan would also rescind as much as $90 billion from unspent COVID money. They include work requirements. They would cancel student loans, and they would also cancel $200 billion worth of greenie tax credits and would reopen the fossil fuel spigots. Every one of these provisions would reduce inflationary pressures and promote economic growth. Spending limits, workfare, fossil fuel production, all this would promote supply-side growth. So the existing money supply would be chasing more goods, hence lower inflation. Powell never talks about this kind of thing. For some reason, he's afraid to take a cue from Alan Greenspan and Paul Volcker, and that's too bad. Now, there's another issue here that we're going to get to with our next guest, Vivek Ramaswamy. That is, the Fed never talks about strengthening the real value of the dollar, which in the long run is the key to price stability. Using commodity prices as a reference point for a true dollar value, as was done under Paul Volcker and Alan Greenspan and the Ronald Reagan Federal Reserve appointees, Wayne Angell, Manley Johnson, and Robert Heller, which gave us price stability throughout the 1980s and 1990s. Today's Fed under Jay Powell never seems to talk about the dollar or its key role in maintaining price stability. But actually, the commodity value of the dollar has been rising for about a year as broad commodity indexes have been declining steadily. Look at that chart. Very important. And by the way, you've got a deeply inverted yield curve. You've got a contracting N2 money supply. The Fed probably is a lot tighter than the FOMC believes. Stabilizing the dollar and promoting lower spending, lower taxes, minimal regulations, all this would solve the inflation problem without throwing millions of people out of work and without destroying the economy. All those Phillips curve Keynesians on the Fed staff don't understand any of this, and that's really a pity. A supply-side solution with a classical value of king dollar would get us out of this stagflation slump that we've suffered through for the last couple of years. Anyway, that's my quick riff